General risk disclosure. Trading financial instruments, including forex, futures, equities, commodities, and cryptocurrencies, involves significant risk of loss. Trading is not suitable for all investors, as it may result in the loss of your entire investment. Leverage, volatility, and liquidity risks are inherent in these markets. Before engaging in trading, carefully consider your financial situation, experience level, and risk tolerance. You should only invest money you can afford to lose. Forex and futures disclaimer. Trading in the forex and futures markets is highly speculative and carries a substantial risk of loss. The leverage nature of these instruments amplifies gains and losses, potentially leading to substantial financial exposure. This content complies with CFTC Rule 4.41. CFTC Rule 4.41 disclaimer. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Equities and commodities disclaimer. Equity and commodity trading involves risks associated with market volatility, company-specific factors, and geopolitical events. While stocks and commodities may have a lower leverage factor compared to forex or futures, they can still result in substantial financial losses. Cryptocurrency disclaimer. Cryptocurrencies are speculative and highly volatile instruments. Trading cryptocurrencies involves additional risks, including regulatory uncertainties, security vulnerabilities, and lack of liquidity. Cryptocurrencies are not regulated by most governments or central banks, and their value may be affected by external factors such as news events and market sentiment. Regulatory references. In the United States, this content adheres to the regulatory standards of the Commodity Futures Trading Commission, National Futures Association, and Securities and Exchange Commission. In the European Union, trading practices comply with the European Securities and Markets Authority standards. Global compliance, content aligns with internationally accepted guidelines, but laws vary by jurisdiction. Consult with a licensed professional in your area. Past performance disclaimer. Past performance is not indicative of future results. Any historical results or performance shown in this content are for informational purposes only and do not guarantee future performance. Educational content disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as investment advice, nor should it be construed as a recommendation to buy, sell, or hold any financial instrument. Always consult with a licensed financial advisor or regulatory authority in your jurisdiction before engaging in trading activities.
All right, let's do the chart work. It's week 3, options expiry week, August 17th through the 21st. Looking at the calendar, Wednesday FOMC minutes, Thursday Philly Fed manufacturing index, unemployment. So light week for options expiry. ECB president talk at 3 in the morning on Wednesday. Some inflation data for Europe on Friday. Fed options expires this week. Look at the COT, S&P, just raw look. Non-commercials are closing out shorts. That's bullish. Commercials are taking profits on longs. That's bearish. About even. Non-commercials a little bit more bullish. Commercials are bearish. Small traders are bullish. And the COT setup favors downside reversal risk. Not a fresh breakout. Then our net positioning for non-commercials, which is basically just the overall trend, is strong bullish. NASDAQ COT. It's balanced on both ends here. Non-commercials heavy short, commercials long. NASDAQ COT is more bullish than bearish because commercials are net long and large specs are net short or heavy short. The clean trade idea is to watch for a confirmed upside reversal rather than assume the move has already started. And then our 13-week average of the non-commercial positioning, they're biased to the downside. Gold. The merchants are hedging because managed money is extra long. Yeah, that's just them hedging. So gold COT is bearish from a commercial positioning standpoint. Commercial side traders are heavy short, funds are heavy long, and report ones of exhaustion reversal risk rather than a fresh low risk long opportunity. Then our 13-week average of non-commercial positioning showed a trend as bullish. Okay, oil. They're long. Managed money's long. I don't really see anybody closing their shorts except for the dealers. they took profits on the dip. WTI, which is oil, is not a clean Larry style commercial buy stream, but commercials are improving sharply. I would call this a developing bullish setup inside consolidation, not an immediate breakout signal from Catalan. And this bearishness is going down. I believe it was a little bit more bearish last week. So this could be lining up with seasonal for a nice buy just because this bearishness is decreasing. Last week it was dark red. Look like a turning point here, trend continuation here. NASDAQ, I could see a retracement. This fits options expiry week with the bearish. I could actually see S&P finish green while NASDAQ finish red, just because it's overall a stronger index. I get the CME Fed watch. The chance of rate hikes went down. It was like 40 something. Then CPI PPI came out. Now it's at 30 something. So sitting still for the 16th of September is the next Fed rate. Not really no big names. Walmart's the only thing close to the top 10. I don't even really see anything super sentiment. QQQ currently has Walmart at number 12 and roughly 2.43% of the weight. And Invesco Zone holding for data confirms Walmart around 2.42%. Walmart also officially confirms its earning call for Thursday. So Thursday before the market open. So there are 0 top 10 SPY QQQ companies this week. Sentiment is interesting. Bearish or bullish went down. Bearish went down and cash on the side went up, which is about average. The bullish sentiment went down a full 3%. Cash on the side went up. Bearish only went up. Bearish only went down 1%. The retail crowd is greedy right now. So this is the American Accredited Investors Institute. These are the certified traders. This just sentiment, fear, and greed. So the retail crowd is more greedy. These guys are kind of playing it both ways. Kind of seen that on the COT too. They're not extremely euphoric, bullish, and they ready to pull the trigger for the bear case. So here we go, NASDAQ. Interesting week last week. We didn't retrace. We kind of just burned off that liquidity by going sideways. Bullish order flow going into options expiry week. I expect some type of retracement when they roll over contracts. Anchor point, the low of the month from week 1 gap, I think stays. I think the retracement can go as low as the fair value for buying and back up. So if we do retrace, I'm thinking up to here. I don't think we take out this until we take this out. Restorative price alignment, inflation worries of subsiding and fabulous earnings momentum is pushing us higher. Also note the expansion didn't retrace the burned off liquidity through consolidation. Set up confidence plan engaged for sure. Nvidia, after that bounce off the 200, we haven't looked back. Nvidia got some slack for spending on data centers. Yes, he's trying to sell the idea everything is going to be okay. One thing to watch is if one data center fails to get built or we have one shut down. Data centers bearish sentiment will kill the movement. Anchor point interaction, the bounce off the 200. Stored price alignment. Nvidia is basically sold out for the next 5 years. They have the strongest future since they are the platform for the AI movement. And the setup plan is engaged. So right now they're just building all these data centers, which sounds good, but it's like selling dreams. We don't know the return on investment and all that stuff. Most of them AI companies not making no money. So everything is good for now. But if you see something on the news like, oh, they couldn't get the funding for this data center, or we had to shut this data center down because we couldn't afford it. Then you can look for a market crash because everything's kind of getting held up by that story. Looking at gold, we was here forever. It was boring. The last 2 weeks been interesting. Last week not so much. So we hit the daily order block and kind of chilled, but we got an expansion. So daily OB reaction. The anchor here is this original consolidation. Story to price. Price was stalling for a while as commercials built the position. Then it just blasted off. We plan on engaging. The one experience skill focus. The focus this week is shot picking and staying with the moves. And journaling intent is staying with price. No case studies. Looking for 2%, 1%, then add in 1% this week. And this options expiry week, so we want to be pushing. Playing strike day is Wednesday, just because we got the FOMC minutes. See this. All right, that's it for the work. Y'all have a good day. Peace.